Welcome to the Paragon Podcast, a podcast focusing on the needs of high net worth individuals and their families. We discuss the markets, tax strategies, and how to better manage wealth with the goal of living better for today while planning for tomorrow.
Hello, everyone, and welcome to the Paragon Podcast. I'm here with Evan Shorten, the firm's founder and principal.
Hello, everyone. I hope you're all doing well. Before we get started, I want to thank everyone who listens to the podcast. If you have not subscribed, I highly recommend it as we cover a lot of important topics concerning your wealth. You can subscribe to the podcast on Apple Podcast app, Stitcher Radio, or you can subscribe to our YouTube channel.
So in this episode, we want to review a previously discussed topic from 2020. Admittedly, this topic didn't get too many views back then, but it's probably one of the most important topics for our clients and our specific audience. Today, we want to discuss changes in IRA beneficiary rules that were imposed by the Secure Act in 2020, and there were a lot. The Secure Act radically changed how IRAs can be passed on to heirs, and this especially impacts IRA owners with large balances.
As you mentioned, the Secure Act introduced a lot of significant changes to IRAs. These changes range from contribution age limits, required minimum distributions, to beneficiaries, and how the IRA can be liquidated. In this episode, we're going to focus on IRA beneficiaries since that represents the most significant changes to IRAs.
If you want to listen to the original episode, you can go back to the February 5th, 2020 episode titled The Secure Act and Your IRA. It's definitely worth listening to so you can learn about all the major changes not covered in this episode. And if you're listening to this episode on YouTube, we'll include a link to it in the video description.
If you haven't stayed up to date to the rule changes concerning beneficiaries, it's very important that you listen to this episode as the changes are significant enough to impact your estate plan. And while this may not be the most exciting topic, it's probably one of the most important topics requiring immediate attention. With that said, the single biggest change to IRAs stemming from the 2020 Secure Act is the elimination of the IRA stretch provision.
And can you elaborate on the stretch provision and its significance?
Yes, the stretch provision was a key feature of IRAs that allowed non-spouse beneficiaries who inherited an IRA to spread out the distributions over the course of their life. For those who accumulated large balances in their IRAs, it presented them with a tool that could possibly stretch an IRA over multiple generations with a high degree of tax efficiency. If an IRA could generate enough returns to make up for the required minimum distributions, the IRA could continually be passed on.
Now, with the passage of the Secure Act, Congress ended the ability to stretch the IRA distributions. So if a beneficiary can't stretch the IRA over the course of their life, that implies that beneficiaries have to spend down or liquidate the IRA before they pass away.
Correct. The end of the stretch provision means IRAs can no longer be used as a tax-friendly tool to transfer wealth. For IRAs inherited on January 1st, 2020 and after, a non-spouse beneficiary must liquidate the IRA within 10 years of the original IRA owner's date of death. There are a few exceptions to this, and we'll address those.
Okay, so to be clear, this is specifically for IRAs that are inherited or that were inherited on or after January 1st of 2020. If you're a current beneficiary who inherited an IRA before January 1st, 2020, these changes don't apply to you. If you own an IRA and you haven't passed away yet, well, congratulations, you're doing awesome. However, if you haven't updated your current estate plan since before 2020, it's important to get on top of it now. So, with the stretch provision gone, what are the new rules for beneficiaries who inherit IRAs?
As I mentioned, the Secure Act requires most non-spouse beneficiaries to liquidate their entire IRA within 10 years after the original account owner's death. Now, there are still a few exceptions, with some beneficiaries being allowed to stretch distributions. These newly termed Eligible designated beneficiaries include surviving spouses, minor-aged children, beneficiaries who are within 10 years in age of the deceased, and chronically ill or disabled people.
Okay, so let's go over how each eligible designated beneficiary can stretch distributions beyond the 10-year period, starting with spouses.
There's no denying that spouses are oftentimes the best IRA beneficiary from an estate and tax planning perspective. A spouse can simply roll over the deceased's IRA into their own without being subject to the 10-year rule. The IRA simply becomes the surviving spouse's IRA, and all of the standard rules surrounding age, contributions, and distributions apply to them. Now, moving to minor-aged beneficiaries, in this scenario, the 10-year rule will be applied to the beneficiary once they reach the age of 18.
Essentially, minor-aged beneficiaries have the 10-year rule plus however long it takes them to become an adult. If a 12-year-old inherits the decedent's IRA, they can stretch out distributions for the 6 years until they reach 18, plus the 10-year rule, for a total of 16 years.
And the third type of eligible designated beneficiary is a non-spouse beneficiary who is within 10 years of the deceased's age, meaning a beneficiary may be exempt from the 10-year rule if they are similar in age to the deceased. And the last eligible designated beneficiary type is a beneficiary who is considered chronically ill or disabled. Please keep in mind, the IRS has their specific definition of chronically ill and disabled. You'll need to check the IRS code for that specific criteria.
One other thing to consider is the ever-changing landscape with respect to distribution rules. For example, when the Secure Act was passed in 2020, the 10-year rule didn't care how a beneficiary spread out the distributions as long as the IRA was completely liquidated by the end of the 10th year. That changed as of March 4th of this year, 2022. The newest IRS interpretation of the rule states if the original owner passed away while taking their minimum required distributions, the non-spouse beneficiary must also take required minimum distributions starting in the first year. If the original IRA owner was taking RMDs, the beneficiary of the inherited IRA can no longer delay distributions until the 10th year. And one last note with regard to the 10-year rule, both traditional and Roth IRAs are subject to the 10-year rule. Okay, so now that we went over the elimination of the stretch benefit, the 10-year rule, and the most recent update to the 10-year rule, it's important to mention how this may impact your existing estate plan.
Right. If you have an IRA with a large balance, it's time to review your estate plan. Unfortunately, if you already made changes to your estate plan after the Secure Act was put into law, you may want to review it again with consideration to the March 4th, 2022 rule change. This is even more important if you hold several $1 million in your IRA. The shorter distribution period could result in unanticipated tax bills for your beneficiaries. Don't forget, if your beneficiary inherits a traditional IRA, they'll be liable for the income taxes on those required distributions. This is also true for IRA trust beneficiaries, which may have originally been created to manage inherited IRA assets. While we can't give specific financial advice on this podcast, it may make sense to consider and discuss some of the following topics with your estate attorney and financial advisor. These include charitable organizations as beneficiaries, increased life insurance benefits to offset estate taxes and income taxes, Roth IRA conversions to move funds from your tax-deferred IRA to a tax-free IRA, and increased giving to your heirs during your lifetime to take advantage of the $16,000 annual gift tax exclusion.
So while this podcast is not meant to give financial advice, we hope this episode has given you something to consider with respect to your estate plan and some topics to discuss with your estate attorney, your financial advisor, or even your CPA. If you have any questions for us, please don't hesitate to reach out to us. We encourage you to email us at info@paragonfinancialpartners.com. If you want to stay up to date with our content or receive our periodic updates, you can visit us at paragonfinancialpartners.com and sign up for our email list. Lastly, please don't forget to subscribe to the podcast. Thank you for listening.
The Paragon Podcast is brought to you by the professionals at Paragon Financial Partners, a registered SEC investment advisor. The topics discussed herein are for informational purposes only and should not be considered as a solicitation or offer to purchase or sell any securities. The financial strategies and guidelines discussed herein may not be appropriate for everyone, as each individual circumstance is unique. Please review all tax information with your tax professional. Please review all legal information with your legal professional. If you have any questions or would like additional information, please visit our website at paragonfinancialpartners.com or email us at info@paragonfinancialpartners.com.